Welcome back, WeMasterTrade family. It's me, Aiden here, and I'm beyond excited to be with you today for another incredible live session. So, if you've been with us for a while, or this is your first time joining, buckle up because we've got a jam-packed session to deliver insight, strategies, and the kind of tips that will take your trading game to a whole new level. Okay, so first up, I have the honors of introducing Scarlett, an absolute beast in the Forex market. So Scarlett has been mastering Forex trading for over 2 years and a half, and she's here to share some seriously valuable insight with all of you. So Scarlett, how's it going?
Hi, I feel fantastic and thrilled to be here. It's always wonderful to engage with the WeMasterTrade community and discuss the successful approaches I recently adopted. I'm eager to delve into some of the strategies I've been applying in the Forex markets.
So I love that energy, Scarlett, and I know the audience is bummed to hear all about your Forex journey. But before we get into that, let's not forget about our next guest, Helen. So Helen has been dominating the fund trading scene, especially in the high-stake world of crypto and stocks. So how's everything, Helen?
Hey Aiden, I'm equally excited to be here. This session always offers great topic for discussions, and today I'm thrilled to share some of the strategy that I have really effective for me in fund trading. It's going to be an engaging session.
So that's what we love to hear, is for everyone watching. Make sure you've got your notepad ready because Helen and Scarlett are about to drop some serious knowledge bombs, and we'll be diving deep into their experiences, challenges, and these strategies that'll help them thrive in the fast-paced world of trading. Alright, Scarlett, let's kick things off with you. So you've been trading Forex for over a year and a half now, and I know that the Forex market can be a bit of a roller coaster. So can you tell us how you got your start in Forex trading and what led you to choose WeMasterTrade as your platform?
Certainly, Aiden. I began Forex trading about 2 years ago, and what captivated me initially was the market's vibrancy and perpetual activity. The Forex market is exceptionally dynamic, and I was attracted to the concept that there is always potential for success regardless of the circumstances. When I first discovered WeMasterTrade, it immediately resonated to me as the perfect match. The resources they provide, including sophisticated technical analysis and access to real-time data, truly impressed me. However, it was the community expert that clinched it for me. WeMasterTrade places a strong emphasis on aiding traders' success by offering essential tools and support to advance, regardless of your starting point.
So that's fantastic, Scarlett. It tells that WeMasterTrade has really helped you evaluate your game. Now, Forex is known for its volatility, and sometimes they can make or break a trader. So how do you handle the ups and downs of the Forex market without letting the pressures get to you?
Great question, Aiden. Volatility can be challenging, but it's also where the real opportunities are. The key is having a solid risk management plan. I always say you have to respect the risk. It's important to stay disciplined, and WeMasterTrade risk management tools help me to do that. Their real-time alerts and customizable risk parameters allow me to allow me to react quickly but with control. When the market moves fast, you have to stay calm, trust your strategy, and not let emotions take over. And for me, that's where WeMasterTrade filters really shine.
So that is, I believe, some seriously valuable insights, Scarlett. Managing risk and staying cool under pressure is definitely key in Forex trading. Now, Helen, let's switch gears to fund trading, okay? So you've been crushing it for nearly 2 years, specializing in long-term strategies. So can you tell us what drew you to fund trading and how it differs from other forms of trading?
Absolutely, Aiden. Fund trading revolves around strategic long-term growth. It's not about shaking a quick win, but constructing a portfolio that can steadily run over time. What truly discourages fund trading is the need to consider both short-term and long-term perspective. Careful risk management is crucial, while simultaneously keep an eye out for emerging opportunities. WeMasterTrade real data and analysis tools have been instrumental in achieving this balance. They enable me to make well-informed decisions that align with my long-term strategy, even when the market presents unexpected challenges.
Oh, I love that. Fund trading definitely seems that it requires a lot of patience and foresight. So, Helen, how do you stay, focused on the bigger picture, especially when the market gets rocky?
Patience is paramount in fund trading. The market experiences fluctuations, but short-term up and down shouldn't dictate your long-term strategy. A crucial lesson I've learned is to maintain emotional detachment. Don't get overly excited when the things are going well, and don't panic when the market dips. We wanted a risk management tool assist me in staying disciplined even during volatility. I can set risk parameters and have a peace of mind knowing that I'm not overexposed even when the market behaves unpredictably.
So that is such solid advice. Keeping your emotions in check is definitely a big part of being successful in trading. So you both have shared some serious gems so far, but let's talk about the tools that will help you to get you where you are today. So Scarlett, could you share one specific feature on WeMasterTrade that's been a game changer for you in Forex?
Definitely, a tool I absolutely rely on is the account insights feature. It offers up-to-the-minute data on how my account is performing, and I use it to observe patterns, evaluate my trades, and make better informed choices. Whether I'm pinpointing the best time to enter the market or deciphering market trends, this tool gives me an edge. It has enabled me to spot opportunities that I might not have noticed otherwise.
Okay, so that sounds like a total game changer. Having that real-time insights is crucial, especially when you need to make quick decisions. So, Helen, how about you? What has been your go-to tool in fund trading?
Okay, for me, it's all about the risk management tool. They allow me to customize my approach I'm willing to take on any trade. This has been key for me, especially in volatile markets like crypto. WeMasterTrade helped me stay disciplined and in control, ensuring that I never take more risk than I'm comfortable with. That's what keeps me grounded even when the market is going well.
So, risk management is really important, especially in today's fast-moving markets. Whether you're in Forex or fund trading, having the right tools makes the world of difference. So, I hope that everybody's taking notes because Scarlett and Helen are dropping some serious product-level insight today. To further give you a better understanding of what company is offering, we're going to give you one of the most helpful features here at WeMasterTrade, which is a packet comparison. Whether you are a fresh trade newbie eager to get your feet wet or a seasoned pro looking to scale your strategy, this segment is for you because this is where you'll definitely find the perfect trading package that match your goals and take your trading from good to great. Okay, so let's be clear here at WeMasterTrade. We know that there's no one-size-fits-all in trading. Every trader is unique with different styles, risk tolerance, and strategies. So that's why we offer multiple customizable packages to meet you exactly where you are in your trading journey. Whether you're aiming for high risk or high reward, or you prefer this steady methodical approach, there's something here for you. To break it all down, I've got the awesome Helen and Scarlett, so two of WeMasterTrade finance. So they have both worked closely with these packages and they hard to give us the insight scoop on how to leverage each one to their fullest potential. Okay, so let's start with Scarlett. I believe that you've been with WeMasterTrade for a while now, and you probably have seen firsthand how these packages can evaluate a trader experience. So, can you kick things up by walking us through, how both new and experienced trader can benefit from the packet comparison, and why is it just a game-changing feature in a WeMasterTrade experience?
Absolutely, Aidan. I really enjoy discussing these packages because it's where traders can truly customize the experience. The package comparisons feature simplifies the process for traders to understand precisely what they are getting. When you visit the website, there's a detailed comparative overview of each package that includes information like the initial balance, profit targets, daily loss limits, and more. All the essential details are presented in a straightforward, easy to navigate table. It's all structured to assist traders in selecting the best tools for their success. Now let's talk about a standard package, one of the most popular options. This one is great for traders who got some experience and are ready to level up. You start with an initial balance of up to $200,000, which gives you plenty of room to trade confidently and make strategic moves. The profit target is set at 6%, which is perfect for traders aiming for steady, sustainable growth, and the daily loss cap is 4%, so you got enough breathing room to ride out market swing without stretching too much. It's an awesome balance between opportunity and security.
So that sounds like a perfect stepping stone for traders looking to level up without jumping in too deep or too quickly. A 200,000K balance and a solid 6% profit target give you, a ton of flexibility to build momentum. But for those who are looking for something, a bit more thrilling, so let's talk about the 5-10-10 package, Scholar. So I hear that this one a favorite for high risk, hard reward traders. So what makes the 5-10-10 such a standout?
Well, the 5-10-10 package now will take in big place. Like the standard package, you start with $200,000, but this package is for those traders who are ready to take on bigger risk for bigger rewards. The daily loss cap is 5%, giving you more flexibility in how you can handle the market. But here's the kicker, the profit target jumps to 10%. This is perfect for traders who have confidence in their strategies and are looking to make those major gains. It's all about having higher tolerance for risk in exchange for bigger payouts.
So now that's what I'm talking about, a 5% loss cap and a 10% profit target. That's definitely for traders who aren't afraid to go big and swing for the fences. But what if, looking for something more relaxed? Maybe they want something simpler without all the prices of the specific profit targets. So Alan, I heard about the 5-10-0 package. So can you break it down for it?
Absolutely, the 5-10 package is the ideal for traders who want a straightforward, no-nonsense approach. You start with a $100,000 balance, but here's the cool part, there is no profit target. You can trade freely without the threat of hitting specific percentages. It's just you, the market, and your strategies. The daily loss cap stays at 5%, giving you some structure. But the beauty here is that it allows traders to focus on consistency without worrying about specific goals.
So that sounds like a dream for traders who just want to trade without all the restriction. So total freedom, no pressure, just you and the market. Now Alan, what about those traders who want a bit more control over their risk management but still want to play in that high stakes arena? So what can you tell us about the 5-10-10 no PC package?
The 5-10-10 no PC package is perfect for traders who want more control over their trades. You still get the $200,000 starting balance and the 5% daily loss cap, but the flexibility is the real selling point here. This package allows you to track and adjust your trading parameter to match your style and risk management reference. Whether you're reacting to market changes or want to experiment with different strategies, this package gives you the freedom to adapt without losing the safety net of risk management.
So flexibility and control in a volatile market, that's huge, and I love how these packages are giving traders more ways to grow. Now that we've covered a lot, but I've been hearing whisper about something really special, the custom package. So Scarlett, tell us, what makes this one so exciting?
Well, the custom package is where things get really exciting. This is for traders who want it all. Full control, full customization, and the massive starting balance. You get a jaw dropping for $100,000 initial balance, yes, for $100,000. But that's just the beginning. The real beauty is that you can customize everything: the loss limits, max loss limits, and even your profit target. Well, it's perfect for traders who know exactly what they're doing and want to craft in a trading experience that matches their exact needs. Is the ultimate in freedom and control.
So 400,000 starts in balance and the ability to customize your entire trading experience. Oh, I believe that it's next level trading. So the custom package sounds like the ultimate playground for one, take this strategy to the stratosphere. So let's just quickly recap everything that we have gone over so far. So we're just getting stars there with the standard package, or going bigger rewards with the 5-10-10 package, or enjoying full freedom with the 5-10-0, taking control with the 5-10-10 new PC, or customizing everything with a custom package. WeMasterTrade, I believe, has the perfect option for you. So the only question left is which one is calling your name. Okay, so now you can just head over to packet comparison section on our website right now and check it out for yourself. We've got packages designed to fit every trader no matter where you are in your journey. So let us know in the chat which package speaks to you, and our team is ready to help you get started. The future of trading is in your hands, so let's make it happen. Okay, so next up, I believe, is where magic is going to happen, because we have talked about how packaging works and how you can jumpstart your journey with WeMasterTrade. Oh, but let's be real, success in trading isn't just about the package that you choose. It's also about understanding and sticking to the rules. So the conditions that we have set to it, WeMasterTrade are designed to not only keep you safe, but also help you grow and take your strategy to the next level. So whether you're just getting started or you have years of experience in trading, this condition will still act as your roadmap. So let's dive into the rules that define our trading environment, because if you understand the rules, you can master the game. So first on the list, and arguably one of the most important, is the daily loss limit. So Helen, you have been through it all, right? The high, the low, so can you kick things up by explaining to everybody here how this daily loss limit works and why it's so crucial for managing risk?
Absolutely, Aiden. The daily loss limit is one of the most essential rules protection any trader can enjoy. It serves as the daily circuit breaker to prevent you from suffering significant losses on a challenging day. The concept is straightforward. There is a limit to how much you can lose in a single day of trading, and it's determined by the greater of two values: your account balance and your equity at the beginning of the day. Let me break down with an example so everyone understands it clearly. For the first example, let's say you got a balance of the 105,000, but due to some open trades, your equity, including floating profit and loss, either 107,000 at the start of the day. If you're working with a 4% daily loss limit, that means you can lose up to the 4,000, and if your equity falls below the 103,000, you don't trading for the day. For the next example, on the flip side, if your balance is 100,000 and your equity is 99,000, the same 4% loss limit would mean your account would be liquidated if your equity dipped below 96,000. The point is, the daily loss limit is there to make sure a bad day doesn't whip you out completely. It's about protecting your account and give you a chance to regroup and come back stronger the next day.
Okay, so I got it now. It's like an insurance policy for your trading day. You hit that limit and boom, you're out before things get out of hand. But what happens, if a trader accidentally crosses that line? Can they, keep trading?
Well, great question. I don't know if you breach the daily loss limit, your account is automatically liquidated. All your open positions will be closed and you won't be able to trade again, or unless you buy a new trading package. Here's the thing, this liquidation is automatic and immediate. It's designed that way to prevent further losses, but here's a word of caution. Market fluctuations can sometimes cause you to lose a bit more than the limit, depending how fast the market is moving.
Oh, so it's a hard stop. Definitely something traders should keep an eye on to avoid. And now that we have, a clear understanding of what the daily loss limit is and what happens when it hits, so the next question is how to avoid hitting that limit in the first place. So Helen, you have been in the trading trenches for a year. So can you share some practical strategies that traders can use to stay within the daily loss limit? We're all ears.
You got it, Aiden. Staying within the daily loss limits, it's all about being disciplined and following a solid risk management plan. Here are a few key strategies that have worked wonder for me and countless other traders. First, and I can't stress this enough, overuse a stop loss. I know it sounds simple, but it's actually critical. The stop loss ensures that if the market moves against you, you're out of the trade before the thing gets out of hand. Think of it as your safety net.
So that's like saying, guardrails on a mountain railroad. Is that to stop you before you go off the cliff?
Exactly, and it's that extra layer of protection. Now the second strategy is position sizing. This is where a lot of traders slip up. You should never risk too much on a single trade. A good rule of thumb is to risk no more than 1 to 2% of your account balance per trade. This way, even if the trade doesn't go your way, you still far from hitting your daily loss limit and you can keep trading without any major setbacks.
So it's like building your defense. You don't put everything in one play, right? You actually spread out the risk. Well, that's actually makes sense. But what about those moments when traders feel tempted to chase after the losses? Trying to get it all back in one trade?
Oh, that's a big one. Again, chasing losses is one of the biggest mistakes traders make, especially newer ones. This brings me to my third strategy: don't chase losses. If you're having a tough day, take a step back. The market will always be there tomorrow, but if you start chasing losses, trying to recover too quickly, it is easy to make emotional decisions that lead to even bigger losses. And before you know it, you hit that daily loss limit and you're out for the day.
Okay, so it's like trying to sprint when you're ready when dead. You're more likely to make a mistake. Now, Scarlett, these strategies sound smart on, but how do traders stay mentally strong when things aren't going their way? And what keeps them from falling into the emotional trap of chasing losses?
Well, it's all about a mindset. Trading is just as much a mental game as it is a number game. You got to stay calm and focused. One trick is to always have a trading plan before you even place a trade. That way, when things get tough, you stick to the plan and avoid making impulsive moves. And if you find yourself getting emotional, just stop, take a break, and step away from your screen and reset your mindset.
Okay, thank you, Scarlett, for those incredible tips on managing daily loss. And now let's shift our focus to another critical element of the risk management. the maximum loss limit. So this limit is, apart from the day loss limit, this is your long-term safety net, ensuring that you don't deplete your account over time. So it doesn't, unlike the day loss limit, which resets at the end of each day. The maximum loss limit is different, which is cumulative. So when you reach it, your account will be locked and your trades will be closed. So we're going to discuss how the maximum loss limit works, how it's calculated, and why it's so essential for traders at every level. Because whether you are a new trader looking to minimize risk or unexperienced trader scaling your strategy, this limit ensures that you don't go beyond a point of no return. So, Scholar, I know that you got some great insights into the mechanics of the maximum loss limit. So could you walk us through how this rule works and what trader needs to keep in mind as they plan their trading strategy?
Of course, Aiden, the maximum loss limit is a vital rule as often overlooked but extremely important. Essentially, it's there to prevent traders from experiencing catastrophic losses by capping how much you can lose across the life of your trading account. So let's break it down. The maximum loss limit ensures your account equities never falls below 94% of its initial balance. So if you start with a balance of $50,000, your account will be closed when your equity falls to $47,000. That's a total allowable loss of $3,000. However, it's not all bad news. If you start making profits, the limit adapts, giving you more breathing room as your equity grows. So for example, if your account increased to $52,000, you now make $2,000 in profit. Your new maximum loss limit would then allow you to lose up to $5,000 as you're essentially locking in those gains. So the maximum loss limit as a long-term safeguard is designed not only to protect your account but also to encourage disciplined trading by setting boundaries. The goal is to ensure you don't dig yourself into a hole that's too deep to recover from. So here are a few specific examples. So with the case number one, let's say your account balance starts at $50,000, but your equity drops to $49,000 due to some market losses. You're allowed to lose another $2,000 before your account hits that critical $47,000 threshold and is automatically closed. And with the case number two, now if you're doing well and your equity rises to $51,000, you got some extra cushions. At this point, you're allowed to lose up to $4,000 before your account hit that same $47,000 limit. So to figure out where you stand, the maximum loss limit is calculated by adding the sum of your closed positions and factoring in any open positions are still running. Your trading dashboard will show two key metrics. The first one is max permitted loss, which is how much you're allowed to lose overall, and the second is the remaining loss, which shows the loss left before your account is closed. Now, what happens if you hit that limit? Well, unfortunately, if your equity hits that maximum loss limit, the system will automatically close your account for the day. All your open positions will be liquidated, and whether you're profitable or not, and you'll be unable to trade for the rest of the day. So to resume trading, you would need to purchase a new trading package.
So thank you, Scarlett. That definitely helps clarify the nuts and bolts of the maximum loss limit. So it's kind of like a safety buffer, isn't it? Oh, it's there to keep from spiraling out of control, especially when the market gets rocky. Now I imagine this rule impacts different traders in different ways, because whether you are a cautious trader who keep their risk low or a more aggressive trader trying to maximize profits, this limit is one of those things you can't afford to ignore. Okay, so let's bring in our risk management expert, so Scarlett. What do you think are the most common mistakes traders make when it comes to managing their maximum loss limit? And more importantly, what strategy traders implement to ensure they never get too close to it?
Great question, Aiden. You're absolutely right. No matter what type of trader you are, ignoring the maximum loss limit limit can be costly. In fact, it's one of those things can sneak up on traders who aren't paying attention to the long-term picture. And I say the most common mistake is underestimating how quickly cumulative losses can add up over multiple trades. So here are some key strategies I recommend to stay well within your maximum loss limit. So first is set stop loss orders on every trade. This is your first line of defense. Setting a stop loss means you're deciding in advance how much you're willing to lose on a particular trade. The system will automatically close your trade if it hits that number, which protects you from letting a losing trade get out of hand. For example, if you're only willing to lose $500 on a particular trade, you set that as your stop loss, and you won't have to worry about its zero.
Oh, so I love that they put in a safety belt on each trade. Once you lock in that stop loss, it's out of your hands.
Exactly, and then it's all about discipline. And the next strategy is manage your position sizing. This is a big one. Often, traders, especially newer ones, get carried away by putting too much capital into a single trade. But when you risk too much, you also risk losing a larger percentage of your account if the trade goes south. A good rule of thumb is to risk no more than 1 to 2% of your total account balance on any single trade. For example, if your account balance is $50,000, you should only risk about $500 to $1,000 per trade. This keeps your potential losses manageable and well within your limits.
So that makes total sense. You're not putting all your eggs in one basket to give you more room to breathe, right?
Exactly, it's all about spreading the risk so you don't take too big of a hit on any one trade. So the next step will be to monitor your account equity regularly. This may sound basic, but it's incredibly important to keep an eye on your account equity throughout the day. It's easy to catch up in the market's highs and lows, but you should always be aware of how close you are to your maximum loss limit, and your dashboard makes it easy to check your remaining loss. So use it. If you see that you're getting close to the limit, it's time to take a step back and re-evaluate your strategy.
So it's like watching your field gauge. You don't want to be traveling on phones without knowing it.
Exactly, and no one wants to get stuck on the side of the road. The next strategy is to create and stick to the trading plan. Having a well-thought-out trading plan is one of the most powerful tools in a trader arsenal. This plan should outline not only your profit growth but also your risk management rules. For example, if you have a few losing trades in a row, does your plan tell you to take a breath, reset, and or train your strategy? The idea is to have a reset of rules so you don't make impulsive decisions in the haste of the moment.
So it's like having a roadmap where you know where you're going and you have the contingency plans for when things don't go as expected.
Exactly, the market can be unpredictable, but a solid plan keeps you grounded. The next strategy is regularly review and adjust your strategy. Even the best laid plan needs to be reviewed and checked from time to time. You find that you're approaching your maximum loss too often. This may be a sign that your risk management strategy needs adjusting, but you need to tighten your stop loss set or reduce your trade size. The key is to stay flexible and adapt to changing market conditions while always keeping your risk in check.
So that's great advice, Alan. It's all about constant improvement. You can't just set and forget it. You've got to be ready to adjust based on results and the market.
Absolutely, trading is dynamite, and your strategy should be too.
So thank you, Helen and Scarlett, for such a fantastic breakdown of the maximum loss limits. And next up, we are going to enter a short break, and after that, we're going to continue with our profit consistency rule and risk consistency rule and the promotional plans that we are currently running.
Trade. Trade. copy trade. We copy trade.
Welcome back everybody, and now we are going to enter another key topic of today's session, which is the profit consistency rule. So this rule is critical for ensuring long-term sustainable success in trading, as it helps measure and maintain consistency in your profit. So now to give us a clear picture of how the profit consistency rule works and why it's important. So let's turn to Scarlett. So Scarlett, can you break down the rule for us, including how it is calculated and why it is so important for traders to focus on their consistency rather than just aiming for big wins?
Of course, Aiden, the profit consistency rule is a powerful metric that helps you understand how stable your profits are over time. It's not just about making big gains or on 1 or 2 good days, it's about being consistent day in and day out. So here's how the profit consistency rule is calculated. You take your highest single day profit and divide it by the total of all your profits and losses over the given period, usually a month or a quarter. You then express that result as a percentage. Let's go through an example. Say your best day brought in $200 in profit, but over the month your total profits and losses add up to $410. In that case, your profit consistency ratio would be about 48.7%. This ratio shows how much your performance comes from one standout day. Ideally, you want this percentage to be lower. under 20% because that means your profits are more evenly spread out across all your trading days. Now, why is this important? A low profit consistency ratio indicates that you're not just relying on just a couple of big wins to stay profitable. Instead, you're showing that your strategy works consistently over time, even on those days when market isn't giving you a big win. This kind of consistency is the hallmark of a successful long-term trader.
So that's a great explanation, Scarlett. So just to clarify, a lower ratio means that you're more likely to make steady gains rather than being overly dependent on a few good days, right?
Exactly, and then when you're too reliant on just a few big wins, it often means that your strategy is risky or inconsistent. You could go through long stretches where you're not making much money or even losing it, but if your profit consistency ratio is low, it shows that your performance is smoother and that your trading is more predictable and stable over time.
Oh, it's incredibly insightful, and it seems like a critical metric for any traders who's serious about long-term success, right?
Exactly, consistency is the key to sustainable profitability. Big wins are great, but if they followed by big losses or long period of break-even trading, it's hard to maintain momentum. With the profit consistency rule, traders can keep an eye on how reliable their strategy is over time.
So now that we've got a solid understanding of what the perfect consistency rule is, so let's dig into some practical strategy to help traders maintain a low ratio to easily under 20%. So Helen, I know you've got some great tips for us. So can you walk us through how some techniques that traders can use to stay consistent and ensure that their ratio stays in check?
Absolutely, Aiden. The profit consistency ratio is a powerful indicator, but it takes careful management to keep it low. So let's talk about some practical way traders can improve their consistency and avoid becoming too dependent on the rare big win. One of the most effective strategies to keep your profit consistency ratio low is to diversify your trades. This means spreading your investment across different markets, asset classes, or even trading strategies. If you only trade one market, say forex or stock, you're being too reliant on that market performance. By diversifying, you reduce the impact of any single loss and create more stability in your overall performance.
So that makes a lot of sense. So if I'm only trading at, say, the US stock market, like that we could really hit my profit consistency hard. But by adding trades and for example commodities or forex, I could balance some of that risk, right?
Exactly, Aiden. It's all about balance. When one market isn't performing well, another market may be doing better. This way, your overall performance stays smoother and you're not relying on just one or two trades to pull your through. Next up is position sizing. One of the biggest mistakes traders make is over leveraging, taking one position that's too large relative to their account balance. For example, if you have a $10,000 account, putting the $5,000 into a single trade is risky because that's a trade goes south. You could lose a significant portion of your capital. Instead, aim to keep your position size small and manageable, say no more than 1 to 2% of your account balance per trade. This reduces your risk and help ensure that the losses don't overwhelm your profits.
So right, not just about picking the right trades, it's also about making sure that you're not putting too much of your capital risk on any single trade. Smaller, more controlled trades lead to steadier results over time, right?
Exactly. By managing position sizing, you prevent any single trade from having too much impact on your overall performance. It's all about control and discipline. Another crucial element is having a well-defined trading plan. Without a plan, it's easy to get caught up in the emotion of trading, whether that's the excitement of a potential win or the panic of shooting loss. A solid plan outlines exactly when you enter a trade, when you will assess and how much risk you are willing to take. Having a digital rule in play keep you grounded and help ensure that your trading decisions are consistent, which in turn help keep your profit consistency ratio in check.
So that's a really good point. A lot of traders, especially newer ones, probably jumps into trades without a solid plan and end up making emotional decisions, right?
Absolutely, agent. It's so easy to get emotional in the heat of the moment. But if you have a plan, it's much easier to stay disciplined and avoid impulsive trade that could hurt your performance. This brings us to stop loss order. A stop loss is an automatic asset that you set up to close trade if it moves against you. This helps to cap your losses on any single trade and protect your account balance. By using stop loss order, you can avoid the catastrophic losses that can throw up your profit consistency.
So I like the ideas of using stop loss order to sound like a way to take the emotions out of the decision-making process.
Exactly, it's like setting up a safety net. Once your stop loss is in place, you don't have to worry about watching it 24/7. If things go south, the stop loss take you out of the trade automatically, helping you stick to your plan and avoid large unexpected losses. And another important strategy is to regularly review your performance. Just because you set up a solid plan and strategies doesn't mean you should put everything on autopilot. It's crucial to track your trades, see what's working, and make adjustments as needed. You might find that certain markets or strategies are delivering more consistent results than others. By keeping a close eye on your performance, you can tweak your approach and improve your consistency over time.
So it's like performing maintenance on your trading strategy, always looking for ways to optimize and improve.
Exactly, just like a car needs regular tune-up, your trading plan does too. While continuous improvement is key to keeping your profit steady. Well, finally, this is the big one, avoid emotional trading. Whether it's fear after a loss or overconfidence after a win, emotions can lead to poor decision making. If you stick to your strategy and avoid chasing losses or getting overly excited after a good day, you'll see much more consistent results.
So that's such an important point, staying calm and disciplined even when the market is going crazy. Oh, it's easier said than done, right?
It definitely takes practice, but staying level-headed is crucial for long-term success. If you can control your emotions and stick to your plan, you'll be far more likely to maintain consistent profits.
So, alright, so let's actually we're going to dive into another crucial aspect of effective trading, the risk consistency rule. So this rule is key to maintaining both stability and long-term profitability of your trading account. So Scarlett, I know that you've got a great way of explaining it, so can you walk us through what the risk consistency rule is and why it's so important for traders to follow?
Sure thing, I think the risk consistency rule is all about ensuring that you manage your risk in a disciplined, consistent manner. It limits the risk per trade to no more than 2% of your initial account balance. This is really important because it prevents large swings in your equity and helps mitigate the risk of significant losses due to sudden market movements or unexpected events. So let's break it down a little more. A maximum risk per trade idea, which means you shouldn't risk more than 2% of your initial balance on any single trade idea. This includes any floating losses, so you need to factor in all potential exposure. Next up, we have the trade idea definitions. Multiple trades on the same assets in the same direction are considered a single trade idea. On the other hand, trades on different assets or in opposite directions are treated as separate ideas. So, for example, if you own several positions on gold buy, they will count as one trade idea, and the combined risk must remain under 2%. But if you have a gold buy and a TBY sell, they treated as two separate ideas, and each with their own 2% risk limit. Following this rule smooth out your equity curves and encourages disciplined trading, and most importantly, reduce the chances of massive losses.
So thanks, Scarlett, that's definitely a helpful overview. So now let me throw this back to the audience for a second. So traders, have any of you ever found it tricky to stick to the risk uncertainty rule? And how does it feel to have those levers in place? Does it ever get in the way of your trading strategy?
Absolutely, Aiden. The main points to remember about the risk consistency rule are the risk per trade idea. Stick to risking no more than 2% of your initial account balance on any single trade idea. This keeps potential losses manageable and ensures you don't risk too much on any one trade. Next up, we have single trade idea. If you open multiple trades on the same assets and in the same direction, they count as one trade idea, so your combined risk must stay within that 2%. And the separate trade ideas, trades on different assets or in different directions are considered separate ideas. So each of these can have its own 2% risk, but be mindful to keep track of them. So why does this matter? It stabilizes your equity curves by preventing huge swing in your account balance. And it also promotes discipline by encouraging traders to think more carefully about their risk. And most importantly, it reduces the risk of major losses that can really hurt your overall performance. So in short, adhering to this rule helps keep your trading account safer and supports long-term success.
Oh, that's great advice, Gareth. And maybe some of you are wondering how to make sure that you actually stick to this rule. So let's shift gears and get into some practical strategies for making it easier to follow. So Helen, could you share a few tips on how traders can stay disciplined and avoid breaking the risk consistency rule?
Of course, Adrian, sticking to the risk consistency rule takes some planning and discipline, but it's total and doable with the right strategy in place. Here are a few key tips. For the first tip, define risk limit. First and foremost, clearly set your maximum risk per trade idea to stay within the 2% limit. You can use risk management tool or calculator to help with this. Most platforms have a built tool that allows you to automate risk limit.
So that's a good point, having that automation takes a lot of the pressure off, right? No need to constantly double check your platform does how they lift them.
Exactly, it makes so much easier to stick to your risk limits when the platform handling the number for you. The next tip is monitor position sizing. It's also important to keep track of the total risk across multiple trades on the same asset. For instance, if you are open several positions on gold buy, make sure the combined rate for all those trades doesn't exceed 2%. This is what traders sometimes leave up. They open multiple positions without realizing that combined, they're risking more than they intended.
So even though the trades are, technically separate if they're on the same assets, you've got to look at them at one entity, right?
Exactly. I treat them as one idea because they are exposed to the same market movement. The native and separate trade idea. Speaking of different trades, it's equally important to trade on different assets or in the opposite direction as separate idea. This way you can manage a trade risk individually without exceeding the 2% rule on any single trade.
So you could be running a gold buy and a GPY sales at the same time without violating the rule, as long as you manage to reach for each one separately.
Exactly. Just make sure you keep an eye on risk for each idea individually. The next tip, use risk management tool. I also recommend using risk management feature that many trading platforms offer, like automatic position sizing or stop loss order. These tools can help control your exposure and prevent you from overextending your risk.
Okay, so I imagine these tools really help prevent those moments where you're tempted to take on too much reach in the heat of the moment, right?
Absolutely, it's take the emotion out of the equation and help you stay disciplined. The next tip is regularly review trades. Lastly, make it a habit to regularly review your trading activity. This is something a lot of traders neglect. Reviewing your trades help ensure that your risk per trade remain within the set limit. And if you notice any pattern on area where you're taking on too much risk, you can adjust your strategy to stay compliant.
So it sounds like regular check-ins are crucial to spot potential issues before they become bigger problems.
Exactly, Aiden. It's all about staying proactive.
Oh, I think that covers it. So let's make sure we're applying these risk management strategy and making advantage of the new options available for account management. Thank you, Scott and Helen, for your insight. Okay, so next up we are going to walk you through our streamlined payout process. At WeMasterTrade, we believe in making it as easy as possible for you to access your hard-earned profits. We offer various options for receiving your payouts, including bank transfer, PayPal, and cryptocurrencies USDT. So the choice is yours, ensuring flexibility and convenience.
Thank you, Adam. And our payout process is both fast and secure. After you make a profit and meet a payout requirements, you can simply log into your account, request a payout, and follow the on-screen instructions. Our team will process your request properly, and in most cases, you can expect to receive your funds within 24 hours. It's that simple. And if you ever run into any issues or have questions about your payouts, our customer service team is always here to help. You can reach us via live chat, email, or through our support ticket system on the website. We are committed to ensuring a smooth and hassle-free experience for all our traders.
So transparency is a key part of our philosophy, and that's why we're always here to answer any questions you might have about your account or the payout process. So feel free to add in the comment or trust your queries as we go. Next up, we will introduce you to our very powerful tool, the financial instrument list of WeMasterTrade. So I hope that Helen can help us understand more about this.
Okay. At the simple overview page of WeMasterTrade, you can explore a comprehensive list of financial instruments available for trading, including cryptocurrency, forex, stock, metal, energy, and index. Our platform offers clients the opportunity to trade with more accounts using a virtual fund, and also until exclusive algorithm to copy your trade to our live trading account. On this page, you will find detailed specification for a trading symbol, including contract size, margin percentage, leverage option, and commission detail. It's important to note that due to the market fluctuations, some symbols may not always be available for trading.
Okay, so our vision is to foster a thriving community of elite professional traders, positioning WeMasterTrade.com as a go-to platform for anyone serious about advancing their career. So we are focused on creating opportunities for growth, increased profitability, and long-term success no matter where you are on your trading journey. So for those traders who are looking for ways to keep more of your profit, well, today we have an exciting update that will help you increase your hard-earned profits without changing your trading style. It's all about boosting your profit split by simply choosing the right funding package. So Helen will break it all down for you.
This new update is something that every trader should know about. When you put in the effort to grow your account, goodness, it's be amazing to actually keep more of what you earn. Well, now this new profit sharing book, that's exactly what's happening.
Absolutely, Helen. I know that one of the most common frustrations in trading is feeling like your hard work isn't rewarded enough. But now with this bonus profit sharing feature, you can actually increase the percentage of profits you keep. So it's a total game changer.
So let's get straight into the details here. You can boost your profit split and earn more. So when you invest in an instant funding package with over $175, you get 1 extra percent in profit sharing, and over $350 you get 3% extra in partner profit sharing, and over $500 you get 5% in extra in profit sharing. So how can you help break it down in a real example?
Of course, let's take a look at the $500 funding pockets. Normally, with the instant funding, you start with the 50% profit share, meaning that for every $1,000 in profit, you can make the $500. But with the new promotion, when you choose pockets over the $500, your profit share jump up to the 50% to 55%. That means instead of you taking home the $500 from that $1,000 profit, now you keep the $550. And why does my seem like small change at first? Think about how much that adds up over time, especially for consistent trader. So in short, the bigger pockets, the bigger your profit share will be.
Exactly, Helen. And traders, here, why is this such a smart move? Let's say you're someone who trades consistently and make $5,000 in profits over time. With a standard 50% profit share, you walk away with $2,500. But with the 55% push, you now keep $2,750. That's an extra $250 in your pocket for simply choosing the right package. And the best part, there's no extra effort required. You don't have to change your strategy or take unnecessary risk. All you need to do is select a higher funding package and you'll instantly start earning more from the same trades.
So now some of you may be wondering, why is it such a big deal for traders? So let's hear from Helen on this.
A great question. As a trader, our goal is always to maximize return while minimizing risk. The best way to grow your account is to keep reinvesting your profits. But that's only possible if you're getting a bigger share of what you earn. With a high profit share, you can scale up further, compound your earnings, and have more capital to work with for your next trades. Think about it, if you keep a larger percentage of your profit, you have a more flexibility to diversify your trade, try new strategy, and even withdraw more fun. This is especially important for those who want to trade for a long term. Over time, these more percentage increases add up to thousands of extra dollars. So if you have someone who take trading seriously, this is a huge opportunity to level up your earnings.
That's such an important point, Helen. And from a psychological perspective, knowing that you're earning more per trade can actually help you stay disciplined and focused. Instead of overtrading or take unnecessary risk to hit bigger profits, you can trade smarter because you're already keeping a bigger share of what you make. Plus, this isn't just about individual benefits. The more traders take advantage of this offer, the stronger our trading community becomes. More capital means better trading conditions, market opportunities, and a stronger ecosystem for everyone.
Alright, traders, you've heard it from the expert. This bonus for sharing is your chance to increase your earning without changing your trading style. All you need to do is choose the right funding package and you instantly boost your profit spread. Visit WeMasterTrade.com now and grab your instant funding package.
And so guys, this is an opportunity you don't want to miss. The market is all about making smart decisions, and this is one of the easiest ways to maximize your return. If you're serious about your trading journey, this is a no-brainer. Don't wait too long for opportunities like this don't come every day.
So next up, we are going to enter the economic analysis of today calendar. Can two traders help me with this?
Thank you, Aidan. And next up, we will move to the calendar. Well, with the first news at 12:15 a.m., it's about GBP BOE government policy speak. Well, this is a high-impact event. Speeches by the Bank of England governor often provide clues about future monetary policy. Any hawkish remarks such as concern over inflation or hints at rate hikes could strengthen the GBP. While dovish tone may weaken it, market participants typically look for forward guidance. Next up, we will move to the news at 3 p.m. Instrument IFO reasoning climate. While the reading came in as expected but dropped from the previous month, this decline indicates worsening business sentiment in Germany, the Eurozone largest economy. It reflects a less optimistic outlook and can be perilous for the euro if markets are sensitive to confidence indicators. And next up, we'll have the news at 7:30 p.m. about USD unemployment claims, where the actual is 222,000 and the previous is 215,000. While higher than expected jobless claims suggest a softening labor market. This may be seen as a warning sign for the U.S. economy and can pressure the USD lower, especially if interpreted as increasing the likelihood of a dovish Fed stance. And the news at 7:30 p.m. about USD called durable goods order. While the impact is at medium and the actual is 0.3% and the previous is 0.7%, while the core durable goods excluding transportation is a key indicator of business investment. The decline from 0.7% to 0.3% reflects a slowdown in capital expenditures and can be a sign of cautious business sentiment, slightly negative for USD. The news at 7:30 p.m. about USD durable goods orders. The impact is at medium and the actual is at 2.1% and the previous is 0.9%. A strong bit here with orders rising more than double the forecast. This suggests robust demand for big-ticket items, which can point to economic resilience. It supports a more hawkish outlook from the Fed and can be bullish for USD. Next up, we will have the news at 9 p.m. For USD. Existing home sales, the impact is at medium and actual is 4.14 million and the previous is 4.26 million. A decline in existing home sales suggests weakness in the housing sector. This can reflect tighter credit conditions or waning consumer confidence. It's slightly negative for USD, though less impactful compared to job and goods data. While about the overall USD sentiments, with a mixed signal, the bullish factor is strong durable goods order. The bearish factor is higher jobless claims and weaker home sales, softer core goods, and the market reaction likely choppy or data dependent. Traders may wait for confirmation from Fed speaker or upcoming inflation data before committing to a direction. So that is the news for today.
Thank you, Scarlett, for such a fantastic breakdown of the economic analysis of today, Andrew. And thank you all to your audience for joining us today. We hope that this session has been informative, and that's as you are as excited about the opportunities here at WeMasterTrade as we are. So remember to like, subscribe, and let's share the live stream with others who might be benefit from it. And don't forget to follow us on our social media platforms for more updates, promotions, and trading tips. Stay tuned for our upcoming events, and we look forward to seeing you again soon. Until next time, happy trading.
Copy Trade.